Now, the company recruited a new accountant who has been in the company for just 2 months. To avoid delaying the audit, the accountant has provided the following list of balances with additional information. So we have the list of balances with additional information, which has been provided there. And the amounts are there in shillings. The amounts are there in shillings. There is ordinary share capital, which usually we know in a trial balance setup, we know that ordinary share capital is usually credited. There is preference share capital, is also a capital element, usually credited. Revaluation reserve, retained earnings, inventory. In a trial balance, we know inventory is normally on the debit side. Trade receivables, cash at bank. Trade payables, 10% loan stock, those are liabilities. And sales, those are liability on the credit side, posted normally on the credit side of a trial balance. Purchases are there, credit loss, and they are also the same as bad debts. Credit loss, the same as bad debts. Salaries and wages, insurance, postage and telephone, light and heat, loan stock, interest paid, directors' emoluments, dividends paid, which is under ordinary. Then preference dividends paid is also given, general expenses, motor vehicle at cost, accumulated depreciation, or at 1st of July 2022. So if you look at the date of the information that we are reading here, this was for the year ended 30th of June 2023. So if you look at the dates given in bracket, especially look at the inventory, it was given as 1st of July, retained earnings 1st of July, and you'll realize this should be as at the end of the previous financial year, meaning these ones are balances starting the current year. That's the essence of the dates given. So accumulated depreciation also has the same. This is the depreciation that starts the current year. Then office furniture and equipment, accumulated depreciation of office furniture and equipment there. And again, the date is at 1st of July 2022. That is at the close of previous or start of the current year. Land and buildings given there. Accumulated depreciation again, also given as at 1st of July 2022. Then there is a suspense account. Now, if you look at that suspense account which they are giving, you need now to start asking yourself the entries that were how suspense account was being handled and what makes you to post into this account called suspense account. So additional informations are also there. Additional informations are given there, and we can read the additional informations. I don't know why there are extra rows here. I'm just removing those extra rows, hoping I've not interfered with the question. Additional information number 1, the suspense account relates to an issue of ordinary share capital at par. Yes. So there was an issue of ordinary share capital, and they posted it as suspense account. Under suspense account, the amount is 5,000. We know it's 5 million because figures are in thousands there. Number 2, land is to be revalued upwards by 4 million. Inventory on 30th of June 2023. When is that? 30th of June 2023 should be the date, our reporting date. So inventory, land, information 3, they're talking about inventory to be amounted to 43,150. That is the value of inventory at the close. So that is the closing inventory. Number 4, there is additional credit loss of 1 million, which is reported, while there is expected credit loss, which is estimated to be 2.5 million. So there are these terms. There is expected credit loss. Nowadays, they love these terms, and then they just talk about credit loss. We need just to remind ourselves and know that expected credit loss, the difference between expected credit loss and credit loss. And again, these ones will be closely related to bad debts and provision for bad debts. Provision for bad debts. They are one and the same thing, they're just alternative terms. Credit loss simply mean or is the same as bad debt. Credit loss, bad debt. Then expected credit loss is provision for bad debts. Whenever you are expecting a loss on your creditor, on your credit, on the credits that you gave, you expect some loss, meaning you are not sure if your debtors will pay you back. That is recorded under expected credit loss. So it's the same way you normally provide for bad debts. You give an allowance for bad debts so that whenever they arise, your books are still in order. You already gave a provision. So let's watch for these two terms and we look at it under note number 4. We are going to see what adjustments do we normally do. I remember there was a question we did and we were discussing about how do you handle increase in provision for bad debts. We discussed about that and what is the treatment for decrease or reduction in provision for bad debts. So I believe you still remember these two. We talked about them and we are going to look at it shortly concerning that note number 4 so that we interpret it correctly. Note 5 is talking about salaries and wages, which they are saying excludes an amount of 520,000 due to casual employees hired in June 2023. So it excludes. So the salaries and wages given in these balances, in the trial balance, excludes that amount that were paid to some casual employees. I'm looking for that salaries and wages. I'm just trying to peruse through and I can see it here. So this figure does not contain this amount of 520,000, which is owed to these casual employees. Then, in addition, the audit fee are estimated to be 1.2 million. Number 6, loan stock interest paid is for the half year. Loan stock interest paid is for the half year. In the preparation of published accounts, I believe you can still relate and remember, how do you charge or how do you compute interest or finance cost given the trial balance? So there is the loan stock. I saw it. I saw loan stock in our list here. You can see 10% loan stock. Now, in an audit schedule, they are simply testing you about the concept of double entry. So you need to connect with how you are preparing published accounts, or simply, let's just say, preparation or of the financial statements, statement of profit or loss. This one is not even to the advanced level of, published over statement of comprehensive income. No, even though the basis of argument is the same, the accrual basis of accounting. So the same way we computed finance cost here is the same way you're going to compute it here. And then you ask yourself, when you go to the balance sheet, how do you reason about that finance cost you've charged for the year? When you go to the profit and loss, you start reasoning, how do you treat the finance cost that you charge? And the aspect or the concept of accrual remains constant. So we are told that the loan stock interest paid is for half year. So there was some loan stock interest that was paid. And you can see it is here, loan stock interest paid. So I want us to look at it in the concept of double entry. How does it affect the financial statements, especially the balance sheet, and again, the statement of profit or loss? We're going to see that adjustment in a short while. Then number 7, general expenses, that we are told it includes prepaid amounts. Now, when we have a prepayment, how does a prepayment affect your income statement or statement of profit or loss, and again, your balance sheet? We should be able to relate because it's not a difficult concept at all. Number 8, we are told about depreciation, which is charged as follows. They are saying motor vehicles is charged as a percentage per annum, it is 30%, and it is being charged on a reducing balance basis. You can see this is simply financial reporting concept, which we've dealt with, we've handled in several occasions. We just want to look at the entry. Office furniture and equipment is depreciated at 10% per annum, but now on a straight line basis. We know this basis of computation of depreciations. Building is depreciated at 2% on a straight line basis. Then number 9 is saying there is a corporation tax, which is 6.5. It is estimated to be 6.5 million. What does the examiner want us to do? The examiner wants us to do a task here. They're saying, prepare an audit working schedule. Having how many sections? 4 sections. And they've even gone ahead to explain or give you the breakdown of the sections. They want us to provide draft trial balance. They want us to provide adjustments. They want us to provide profit or loss items, profit or loss. Then they also want us to provide statement of financial position elements for the items there. That's what they want us to provide. Yes. And I don't know really why whatever they are repeating simply is the same as what we have. Because if you want to prepare a draft trial balance, we already have a trial balance here, and we can always see which one goes to the credit and which entries go to the debit. I mean, yes. So for the first schedule, for the draft trial balance, we already have the answer. We just need to put it in order, in an orderly manner, and we have everything worked out. So I will divide my page into 2 and we start answering the question. And this is the approach that you need to employ should you get this question in next week's paper or exam. These are simple concepts and they've loved it. They've proven to love audit schedules, given that it's a bit wide compared to the other sections of audit. Other sections of audit are a bit simpler and easier. Just after you have the concept, there is really nothing much to do. So the basis of preparation of audit schedule is on double entry. We first come up with the trial balance without adjustments. Then we do the adjustments. That is according to what the required party is saying. We just prepare the draft trial balance. Then we do the adjustments. Then we come up with a profit or loss from the adjustments. Now we will be adjusting the original trial balance with the adjustment so that we take to profit or loss statement, its elements. Then we also do the same for the statement of financial position. It's pretty simple concept. And once I told you guys that at such a time, like now, we only have like just a week. It's even less than a week, maximum of a week's time. At this time, you do not gag yourself. You do not have several questions testing on a concept. Pick on selective. Just select 1 question or 2 maximum. 2 should be maximum. Testing a concept. Revise it. Just know the concept and just relax. Do not panic. Do not have any pressure. That I have not revised this paper. Have not revised. No. It's not necessary. You will not do it. It will make you panic. What you have is already enough. Just revise 2 questions on an area. That is maximum. And you can even revise 1 question. If you go to group cash flow, just 1 question, a good comprehensive one, you are done. Published accounts, you are done. Just grasp that concept and you relax. Wait for the paper. You do it, pass, and you go home. Concentrate on other things. All right, now let's do the workings here. We are preparing audit schedule. Now, audit schedule is a very simple thing, as I've said, and the examiner has even guided us. What does the examiner want us to do? To do a trial draft. They called it draft trial balance, which is pretty simple. We know what a trial balance is. We know entries that go to the debit and those which that go to the credit side. Then the examiner also wants us to do adjustments. Adjustments now are because of the additional information, so we will come up with the adjustments. Yes. So a trial balance has both the debit and credit side. So I will simply just, I can come up with the debit and credits because that is the basis of preparation of this. debit, and then credit. Those are the entries that we will do, the debit and the credit entries. And that one we'll do, we start with the trial balance, with the draft trial balance like that. Then I'm just trying to push it in the middle so that the debit and the credit appears at a centralized place. Then we do the same for the adjustments. We will do also the debits and the credits, the debits and the credit. It's a pretty simple thing, and it's really free mark. An audit schedule should be a free mark for any student at this level. Then we are going to prepare draft profit or loss. Draft profit or loss. Draft profit or loss. And this draft, I think I have enough space. Let me just even just type the whole word, profit or loss. And it is a draft because it is based on the adjustments that we are given in the additional informations. So it also has the two sides. So the concept that we remember about the profit or loss is we ask ourselves, what do we normally debit in the statement of profit or loss? Then what do we normally credit in that statement? We know where expenses, the revenues, we know provision for bad debts itself. So those are the tests that the examiner wants us to do. Then the examiner wants us to finally give also a draft of a financial position, statement of financial position. And all of them are draft statement of financial position. Draft statement of financial position. And this also follows the same concept. Now, in an exam, once you do that, what you need to do is just to separate or divide the columns so that there is a clear demarcation. What do I mean? Now, you remember we have the draft trial balance on its own here. So you need to make sure there is a clear demarcation between the two statements that we're working with. So I can just use even this right border to divide or separate the pages into two. Some people like using colors, which is still okay. You can opt to use colors so that you separate the statements or the drafts that you are doing. And this will make you not get confused when you are doing your entries. Then now statement of financial position, of course, comes at the end. It comes at the end like that. So is it this column here? Okay, so that is it. I think that one now is in order. Then maybe I just put one line for the titles like that. Now, these draft statements, we are going to prepare them according to the information that we've been given. So when you get this thing in an exam, what you need to do is very simple. The draft trial balance is now the very first one, and it is simply what you've already been given. So what do? You just go and start doing the same elements without looking at the adjustments. Adjustments come at the level of additional information. So do not check on the additional information first. When doing draft, you are simply working with the balances given. So what you do, and in fact, I suspect that this is not the original appearance of this question. These debits and credits ought not to have been given. If the examiner gave them, then the examiner already gave us the answer for the draft trial balance. I mean, this examiner was very considerate. So I will just want to start transferring the balances. And what I do, I just refer to the first element. And what do I do with the first element? Once I've referred to it, then I just autofill. Now, when I autofill, you realize that it is bringing on board all these elements, the way they follow each other, and I'm at light and heat, which is here. And because it's continuous, I will just drag them, and it is at land. I still have like 3 more, and to suspense account. Now, once I do that, so what I go to do next is to ask myself, now these elements, which one should go to the debit side of a trial balance and which one should go to the credit side of a trial balance? Even if you are not given, it is not posted on the debit or credit, in most cases, they will just write balances or amounts. They just write shillings in thousands and they give you everything in one column. They just give you everything in one column. So it is you to make a decision and know which one goes to debit and which one goes to credit. Yes, which one goes to debit and which one goes to credit. Now, that is basically what they are testing here. So we want to start by doing the entries. Ordinary share capital, preference share capital, revaluation reserve, and retained earnings. These first four elements are elements of equity. These are elements of equity. And we know these elements of equity or capital, they normally go to the credit side of a trial balance. So what we do, we go to the credit side, credit column, and we refer to the first element. And this is the first element for, and I've not put the level of precision. All our figures are in thousands. So I think that is also very, very important. We ought to have put that. It is very, very important to make sure that you give the level of precision. Amounts are all in thousands. That will be very important, because if you don't give that level of precision, then somebody will assume the figures that you are giving are just like that without putting the thousand bit of it. So I just want to autofill them like that. Then I can still put that line, which is still okay. All right. So I'm seeing some chat here. What is a member saying? I've already sent the question on WhatsApp, Collins. It's the same file we used yesterday for the three-way order matching. There is a tab written August 2023, question 24. But again, any member who has the question ready, you can shoot it in the WhatsApp group, or you just send it in the chat box here for the good member there to have it. All right, I hope someone is doing it. So I was saying the first four elements are equity elements, and we credit them. I've credited ordinary share capital. I'm going to bring on board preference share capital. These are elements of capital. It's also a credit balance. We do the same for revaluation reserve, which is also an element of equity. After that, we do the same for retained earnings. That is the opening retained earnings, the opening one. Now, even as you draft the audit schedule, the draft trial balance, you need to start asking yourself, how do they appear in the statement of financial position? But even as before we do all these other entries, we will have to adjust them where necessary. After adjusting, then we will post them accordingly in the statement where they should be appearing. And of course, at this level, we already know how we normally do that adjustment. So that really should not be a problem, should not be a problem at all. So we continue with the next element. We are starting from inventory. This is the opening inventory. We ask ourselves, Nathaniel, thank you. Nathaniel has shared that file. So for Collins, you can be able to now get it from the chat area. So inventory, opening inventory is usually a debit balance in the trial balance. So I will go to my debit side and pick opening inventory and post it accordingly. Then, why is it coming as a 0? Where is opening inventory? Here. All right. Then trade receivables also should be a debit balance. Trade receivables should also be a debit balance. So I will also pick trade receivables and post it where it should fall. I see I'm just following what has already been done. Though there is that reasoning aspect, should you be given just a list of balances, you need to know which one goes where and why. Cash and bank, we know that is a current asset, normally on the debit side. Then trade payables, these are liabilities now. Trade payables, 10% loan stock, these are liabilities, and we know they appear in our balance sheet, but on the credit side. So where is trade payables? Already I see it was credited here. That's where it should fall. Then we go to 10% loan stock, which is also liability, credit side. Then I'm also going to the same element of, all right, Liabilities end there. We go to sales. Sales is also revenues normally credited in the statement of profit or loss. So in our trial balance, it has to be credited. Where do we normally record purchases? Purchases is part of cost of sales, computation of cost of sales, because I believe we know that when computing cost of sales, we normally start by opening stock. Then we normally add purchases. Then you normally add any expenses that are involved in bringing on board the goods into your premises, carriage inwards. We normally add it. Then whatever you may have purchased and you need to return it, you normally return it. We call it purchase returns. These are elements that normally adjust to give us cost of sales. Then eventually we less any closing stock, so that we ask ourselves, what is the cost of the items that we sold, cost of sales. So these adjustments already you've seen we've debited opening inventory there. That is part of computation of cost of sales. Now there is the purchases that we've just talked about, and now we're going to debit it because it forms our cost of sales. So it appears normally on the debit side of statement of profit or loss. So I would go and pick my purchases and post it on the debit side like that. Then we are having credit loss or bad debts. So when we talk about credit loss or bad debts, where does it normally appear in the P&L? I believe we know that that is normally debited. Bad debts, normally an expense. Expenses are debited in your statement of profit or loss. So I will pick the 17. Then salaries and wages expenses. Insurance, these are expenses. Postage and telephone, all expenses, normally debited. Light and heat, also expense, normally debited. I want just to come up to this. We now start reasoning from the loan stock paid. These other ones should just be auto-filled because they are expenses normally debited. And I hope that no one has a problem with the posting in this trial balance. How to debit or credit, that should be so basic and we all should be comfortable. Let's look at loan stock paid. Loan stock interest paid. Where should it fall? Should it be a debit balance or a credit balance? And why? Somebody to just talk to us. Loan stock interest paid. If you're supposed to debit or credit, why? I just need somebody to give us an opinion there.
We should debit it because it's an expense.
We should debit it because it's an expense. Thank you, Winnie. Someone else, debit. Grace is saying it's an expense. Though Jaden is not agreeing with the two, Jaden is saying this should be credited. Though Jaden is not giving us a reason, I was almost talking about he or she, but because I'm not sure, let me just call this member Jaden. Pataki debit is an expense. Jitume is an expense. We debit. Fei, we debit. Wilkista is also supporting what Jaden was saying by saying we credit, though they're not giving reasons. For people who are talking about debit, they've said it's an expense. I want a reason for Wilkista why you are saying it should be credited, and also Jaden. Are you able to support your answers? Are you able to support your answers? Why you are saying we are supposed to credit loan stock interest paid? Loan stock interest paid. What is your reasoning why you are saying we need to credit them? For the members who are supporting credit. For debit, they've said it's an expense, so we need to debit. I need an explanation for credit. What is the supporting answer so that we see the correct treatment of this element? Yes, no one is speaking. The members who are saying credit, are you having a supporting argument? Do you have a supporting argument? Because if you talk about credit, if you talk about crediting it, when you pay a loan stock, I see a response here. Let me see what the member is saying. Jaden is saying we should debit and credit cash and bank. All right. Thank you, Jayden. Thank you, Jayden. I think members, we understand that because look at it in terms of a transaction. In terms of a transaction, when you pay loan stock interest, remember, you are paying it as an expense. And where do you pay it from? You are paying it from either cash or from bank. So, in other words, you will be crediting either cash or bank account. So when you credit the other account where the payment is coming from, obviously you will be debiting your loan stock interest account. You will be debiting your loan stock interest account as you credit where the money is coming from. So that account must balance double entry. That is the basis. So that loan stock interest is also a debit balance. Then directors' emoluments is also part of expenses. Remember, these are like salaries. Dividends paid, dividends paid, dividends paid. The argument will not be different from loan stock paid. Remember, dividend is the return on investment to the shareholders. And as you pay them, you will have to record it. I know it is under appropriation. It is under appropriation, statement of changes in equity, where we normally record dividends. Remember published accounts concept. But as much as it's an appropriation, in the perspective of the company, you look at it as an expense because you are paying your shareholders. So when you pay them, you look at it as an expense because it is money out, it is an outflow. Though we know the treatment in published accounts, it normally appears under appropriation section. So these ones will also be expenses, the same way we've talked about loan stock interest. General expenses, that one we don't have to argue. These are still expenses. We normally debit our profit or loss. We come to motor vehicle at cost. Now, this one now is an asset. Motor vehicle at cost, we know that in the balance sheet, assets are debited. Then, accumulated depreciation. I believe that for the longest time, you've interacted with this trial balance having this accumulated depreciation, especially in published accounts, preparation of financial statements. You normally see on the debit side, they give you the asset at cost. Then accumulated depreciation, usually it is credited. It is usually credited. Why do you credit it? Because accumulated depreciation normally reduces the asset account. So if the asset account is given at cost, this depreciation is what has accumulated since it was purchased. Asset, as it is being used, its value goes down every year. So the accumulated amount by which the asset has reduced in value is recorded under accumulated depreciation. So whenever you want to get the net book value of this asset today, you will knock off the whole depreciation, we call it accumulated, for the entire period it has been in use. So that's why accumulated depreciation is usually on the credit side. It reduces the asset account. Whatever you debit on the asset account increases it. But whatever you credit to the asset account will reduce it. So accumulated depreciation at the start will be on the credit side. This was even already posted here, which is the right treatment. Then office furniture, this is an asset account. Remember, that is normally debited. So we'll just debit it like that. We'll check on accumulated depreciation again. That treatment remains the same and the reasoning is similar to the one we've had above. Then land and buildings, these are asset accounts and the balances normally will always be debited in our draft trial balance. So draft trial balance is normally just the same balances you have. You just make sure they are correctly posted as debit and credit. Accumulated depreciation, nothing different. The treatment remains the same. It is on the credit side. Then suspense account you've been given here, but it's been credited. Suspense account has been credited. And remember, we were told in note 1 that this suspense account is a result of what? Issue of ordinary shares. Now, that will affect ordinary share capital account. Those equity elements, we normally credit. So that's why they even credited that suspense account. Okay, so with this one, we should already be closing our draft trial balance because we don't look at the adjustments at this level. So I can just go ahead and get the total net effect, and I'm using alt equals. And when you use alt equals, you need to be able to check. First, I think let me just draw the lines, the double line there. And I put it in bold. And I can write either totals or I just leave it. Let me just write total. I think there is no harm there. Then alt equals. You have to always check the range. You see, by default, it will give you, but if there are those blank spaces in between, it may not give you the correct. So make sure you always adjust your alt equals formula. Adjust it so that you pick within the correct range that you are looking at. So once I do that for the first one, then these others will follow suit. Where are we supposed to end at this point? So ideally, I should just end here. That's where my double line should end, like that. Now, with those, we should now go ahead and do the adjustments. We should now go and do the adjustments. So to do the adjustments, let's look at the additional informations. We are starting from the first one. What adjustments are we supposed to do? What adjustments are we required to do? For the draft, this is all that you're supposed to do, and you score your marks for the draft. Remember, we were told it is a 10-column schedule. No, they said it is 8 columns. Sorry, it is 8 columns because there are 4. Draft has 2, adjustment has 2. Those are 4. Profit or loss has 2. Those are 6. Then statement of financial position has another 2. So that makes it 8 columns. We are done with 2 columns. Now, adjustments. Now, this is the area where you need to be a bit keen. For the draft, everyone will get this right. I can bet. Everyone, almost everybody, 99% will get this right. Only 1% of somebody may confuse an entry to be debit while it should be on the credit or otherwise. But in most cases, students don't have a problem here. This is where the differences will start coming in. You know why? If you make any wrong adjustment at this level, your profit or loss may be wrong, and your statement of financial position may also be wrong, because they depend on the adjustments. So this is the most critical area, and I can even go ahead and highlight it. This is the most critical area. If you do it right, everything that follows will be right. And you know what that will translate to? You will get full marks. You will get full marks. The 20 marks, you'll bag it if you adjust correctly. So let's look at the adjustments one by one, and we see what are we supposed to adjust, how and why. How and why. All right. Now, let's look at additional information 1. We read together and we do the adjustment. Okay. Somebody, Rose Joy, wants to see my trial balance from what I have seen from furniture. So my trial balance from furniture, where is furniture? Furniture is here. This one here, Rose Joy, office furniture and equipment. I hope you've seen it. I hope you have seen it. Okay, so let's look at note 1 and we adjust accordingly. We've been told that the suspense account relates to an issue of ordinary share capital at par. Issue of ordinary share capital at par. Now, whenever you issue ordinary share capital at par, remember, we talked about elements affecting share capital. And whenever there is an issue of shares, you need to start thinking, is the issue at par? We need to know, and I believe we know, when the issue at par, what it means. You are issuing at the par value. When you issue above par value, then that's where share premium comes in. When you issue below par value, then you've issued at a discount. We know that already. So there was an issue of shares at 5 million, but they've told us it is at par. Now, we need to identify the 2 accounts that it will affect. Rule of double entry is what will help you in the adjustment section. When you issue shares at par, which 2 accounts are affected? When you issue is at share premium, which accounts? When you issue at a discount, which accounts? Let's start with the par because that is what the question has. The issue realized amount of 5 million. Which 2 accounts are affected? Which 2 accounts are affected? And what are the entries? Yes. Which two accounts are affected? Win is saying debit suspense, credit ordinary share capital. All right. Then Grace is saying ordinary share capital and share premium. Grace has brought in an element there of share premium. And I will ask Grace to justify the share premium bit. I will agree with ordinary share capital, but share premium bit, Grace, are you able to defend it? Because the term given, they said the issue was at par. If I'm not wrong, I'm just looking at it. They said at par value. So I'm wondering why Grace is talking about share premium, unless she can defend. Grace, can you defend? LJ is talking about suspense and ordinary share capital. Can you reduce and what? To increase. Can you reduce your formula bar to increase display? Oh, okay. I will adjust it. Okay. Pataki, ordinary share capital and suspense and ordinary. Grace has not responded. Realme, Mawia, debit, suspense, and credit, ordinary share. Okay, Jayden. Grace has not responded. Okay, good. Thank you. It's good you've noticed that it was at par, not at premium. So members, I see all of us now understand the entry, the double entry that is required for all those. So I believe that we've understood that the two accounts affected. We have to correct this account. Remember, it was credited. So for us to correct it, we need to debit it. We need to debit our suspense account so that we correct it. That is the one entry that we need to make under adjustments. So I want to start with it. In the adjustments column, this suspense account was credited, so I will debit it with the 5 million. Then after I've done that, I will always go and now do another. For every debit entry, there is a corresponding entry. That is the rule of double entry. So in the ordinary share capital account, we are going to increase it by 5,000 or 5 million. Why are we increasing it? Because there are additional shareholders who have come in. They've brought in money. So our share capital base is going up by 5 million or 5,000 in this case. So once you've done that, you will always realize that your balance sheet should always be balancing. Your balances should always be the same at any given time. So for every debit, make sure you do a credit. That is how to adjust. So that one adjustment is done. And once we have adjusted it, we can now go ahead and post it where it should go. But for now, let's just do the adjustments, all of it. Then we now will start posting the adjustments plus the original to either statement of profit or financial position. We will do it. And this is the main thing. Once we are done with this, whatever is remaining is now very simple. It's just transferring figures. Look at note 2. And I want you to tell me which postings are we doing, which accounts, and how are we posting. Number 2, land is to be revalued upwards by 4 million. I need the two accounts affected by that. Land is to be revalued, and the postings. Tell me, we debit this, we credit this, because that is the rule that we are following. One is debited, one is credited. Which accounts are we affecting by that adjustment? Which accounts are we affecting by that adjustment? I see responses there. Let me just go through them, which is very good. All right. Debit land, credit revaluation reserve, debit land, okay. Debit land. Admin is saying revaluation and credit. We credit revaluation. Okay. Lillian, debit land, credit revaluation surplus, debit land, revaluation reserve, okay. Admin is saying land debit, okay. Cherotich, LJ, Jitume, I can see we are talking about the same things, debit land, okay. So members, I will agree that the responses are correct. We are debiting land And I believe everyone understands why we are debiting land. Remember, when we were doing adjustments in published accounts, we were talking about PPE. We were talking about PPE. And we said that PPE, okay, it is a rule in published accounts that we classify all the non-current assets under the title of PPE. And we know that investments do not fall here, intangible assets do not fall here. They might fall under non-current, but they don't fall here. Now, when we were adjusting for PPE, we mentioned some elements. We talked about purchase. Remember cash flows. Remember cash flows. Whenever you purchase any element of PPE or asset, it increases the value, meaning it will be debited. You will debit any purchase. Then, if you dispose any element of an asset, it will reduce the value of that asset. I'm using the word PPE to represent the non-current assets. Whenever there is a disposal, you will be crediting that asset account because it is being reduced. Yes? Whenever there is revaluation, and the revaluation I'm talking about here is upward revaluation. Remember, revaluation can always go down. So if there is an upward revaluation, this one will increase the asset account, and therefore we normally debit that asset account by that. Anything else that affects that? I've talked about purchase, disposal, upward revaluation. So this disposal, we can also use the word sale. You can either sell it, they can use the word selling of an asset, they sold, or just disposal. It's still the same treatment. So with that note 2 talking about land is to be revalued, that revaluation will increase the net book value of an asset, of the land now, in this case. And when it increases, remember, land will be debited because this value has gone up. The same thing I've written here. We'll debit it. But there has to be a corresponding credit entry. So we ask ourselves, what increased the value of land? It was revaluation. Where do we normally post revaluation? In the revaluation reserve account. Remember, revaluation reserve account is an element of equity. In the statement of changes in equity, we normally posted revaluation reserve, any revaluation adjustments onto it, and revaluation reserve account was given. So we are going to increase this account by adding that value of revaluation. So let's do the two adjustments there. So the first adjustment, we can just start from the element or the first account that is affected, that is revaluation reserve. What do we do to it? We are increasing the revaluation reserve. To increase it, we are crediting. We are crediting by how much? We've been told the figure is 4 million. And because our figures are in thousands, I will just type 4,000. That is the credit entry. Now let's do the opposite debit. And the debit now is affecting land. Where is land? Land is here. And now the land we now debit because it has been revalued upwards. Its value has gone up by 4 million or 4,000 in this our case. And you will see every entry that you do, every adjustment that you do, your account will always be balancing. So this is your checklist. And you can mark yourself in an exam. When you are doing this question in an exam, make sure you set the formulas. And once you set the formulas, you'll be checking that after you've done the double entry, make sure that you review if the account is balancing. If it is not balancing, you've done a wrong entry. If it is not balancing, you've done a wrong entry. So there has to be a balance at every adjustment. So let's look at note 3. They're saying inventory on 30th of June amounted to 43,150. This is closing inventory. This is a closing inventory. And they've given us an amount there. What adjustment are we doing to that closing inventory? What adjustment, which account are we adjusting? And by how much? Which account are we adjusting and by how much? I want to see. This is a very interesting one. Which accounts are we adjusting? Which accounts are we adjusting? Let me see. Debit statement of financial position. Credit income statement. All right. Thank you, Grace. Credit income statement, debit statement of financial position. Winnie is saying debit inventory. Okay. Credit inventory in the statement. Okay. That's very good. Thank you, members. I think we now need to understand that Maria is saying closing inventory will affect both P&L and financial position. That's right. Thank you. So, members, whenever you look at that note 3, the information given, it is not an adjustment. That is not an adjustment. We are not adjusting any account at that point. We are not adjusting. What we are doing is a posting. We are not adjusting. Remember, adjustment is affecting an original account. Original account was given in the draft trial balance. So it's what we are adjusting. You cannot adjust an account with no balance. And you cannot get an account of closing inventory having an opening balance that needs to be adjusted. So what we are going to do, we are going to post the entry in the correct accounts like members have said. We are going to debit. We are going to debit our statement of financial position with that closing inventory. And then we are going to credit our P&L with that closing inventory. I believe you know why we are crediting P&L. I wrote a formula here. You see the formula I wrote here? In the computation of cost of sales, which is a major element in the statement of profit or loss, we normally deduct what? We normally deduct closing inventory. That's why we are crediting. We are crediting. To deduct in the statement of profit or loss is to credit. So this less closing stock mean that closing stock figure, we are going to credit it in the income statement. So what am I going to do? I'm going here to write here closing inventory. Remember, it did not have any balance and it should not have. This is an entry we are making. And where are we making the entries to? Our statement of profit or loss. We are going to deduct it in our computation of cost of sales. So we're going to adjust it there. What amount was it? Note 3. 43,150. 43,150. So I'm just going to post 43,150 there as a credit in the income statement. And then I'm also going to post in the statement of financial position as a debit in the closing inventory. I'm going to debit it. So I've put in a credit. Now I'm going to debit it here. Oh, it's just besides it. So I can even just refer to it. 43,150. Remember, when you are posting, your account is not balancing. These accounts here depend on the adjustments and the draft. So whenever you get an element you're posting directly like this one here, do not expect the account to balance. There is no debit and credit under income statement. And there is no debit and credit in the balance sheet. Do not expect these ones to balance at this point. So long as you've done a credit and a debit, you are done with that posting. That is a posting, not an adjustment. Under adjustments is where it will always be balancing at every stage. I hope somebody understands that. Note 4. Note 4, we are told additional credit loss of 1 million is reported, while expected credit loss is estimated to be 2.5 million. Now, I want your input. Additional credit loss, how we treat it, and we've been told about credit loss, expected credit loss, and additional credit loss. How do we do the adjustments? H is saying repeat. Okay, what I've talked about inventory in note number 3 is that inventory, we've been given the figure is a closing inventory. Look at the date. It is 30th of June, 2023. That is the date of reporting here. So being given that inventory figure, which is a closing inventory, it is not an adjustment. Adjustments only appear under the adjustments column. And the reason why it is not an adjustment is you only adjust an account with a balance. Did we have any closing inventory account here with a balance? The answer is no. The inventory that we had here is an opening inventory. And the date was even given there to show you that it is actually an opening inventory. Now we already know that it is not an adjustment. So if it is not an adjustment, what is it? Now it is an entry we are making. Now, being an entry, we must do a debit entry and a credit entry for the transaction to be complete. Now, we have two accounts to do the entry into: profit or loss, statement of financial position. We always know that the inventory figure being taken to the balance sheet is always the closing inventory figure. I believe that is a basic rule that all of us normally know. We normally take the closing inventory to the balance sheet. So that's why we have debited, and you know inventory is a current asset. That's why we've debited the balance sheet with it. To the income statement, we know that in the computation of cost of sales, which is a serious element, which is a basic element to get your gross profit in the income statement, we normally deduct closing stock in that formula, which I wrote here. So to deduct means to credit. We know that all expenses are normally debited, but here we are deducting the closing inventory. That's why we have credited the income statement. And even if you forgot the reasoning here, just ask yourself, once you have a debit in the balance sheet, the other corresponding entry should be credit. So every debit, there is a corresponding entry for credit. That's when the transaction is complete. I see responses there. Members are saying debit, credit, loss with 1,000 and receivables with 1,000. Okay. Credit receivables with 1,000. And I can see the responses are consistent. We credit receivables and debit credit loss. Okay. 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 Thank you, members. I think the responses we understand. So, members, I want you to look at those responses and make sure you are not joyriding. Make sure you also understand what the entry mean and if you can also do the same on your own. Now, I want to start from I want to look at the statement the way it was framed. I want to just pick an element and we see. Now, we've been told that additional credit loss. Now, we ask ourselves, what is a credit loss? Credit loss is just a bad debt. Where do we normally post bad debt? Where do we normally post bad debt? Bad debt is normally debited. Bad debt is normally debited in the income statement or the statement of profit or loss. So, if we have additional credit loss, I'm looking at the charts here. I see Grace, Winnie. For expected credit loss, debit expected credit loss with the difference. Then receivables with the difference. Okay, it's bringing out the concept of difference. Jaden, expense debit, loss allowance with credit, which is a provision. All right. I want us to start picking on this figure that they gave us here. They said expected credit loss is estimated at 2.5. Now, expected credit loss is the same as provision for doubtful debts. Provision. Some people call it provision for bad debt, which is still okay. Provision for bad debt. Provision for bad debt. Where do we normally post provision for bad debt? Provision for bad debt. Provision for bad debt in the income statement. And as an adjustment, we have to adjust it accordingly. Provision is normally debited in the income statement. So when you debit the statement of profit or loss with a provision of 2.5 million, then we need to ask ourselves, in the adjustments column, is there an account of provision that we are adjusting? Is there an account of provision that we are adjusting? The answer is no. There is no account of provision that we are adjusting. Is it? Let me see. Credit. Credit. Okay. Now, I want us to just post it directly. But again, I want you to remember, whenever you are adjusting an account, under adjustments, you must have debit and credit. Under adjustments, you must be having a debit and a credit. But when you are posting, you have to make sure you post a transaction in completion. You post it in completion. And we ask ourselves, where do bad debts arise from? Where do bad debts arise from? Where do bad debts arise from? Bad debts arise and it affects receivables. It arises when you sell on credit. When you sell on credit, you have your debtors. And those debtors are normally called receivables, recorded under receivables. So yes, it arises from credit sales. Now, there is an adjustment here. The reason why there is an adjustment is because it will affect our credit sales. It will affect our credit sales, that is receivables. So I want to go and do the adjustment under receivables first. And what adjustment are we doing? We were told there is an increase, an additional credit loss. So part of the debtors have already been declared as bad debt. Part of the debts have been declared bad. So what does that mean? That means we are going to reduce what we expect to receive by that 1,000. And again, we are told that expected credit loss, of course, that did not have a balance. We are going to increase what to reduce what we are expecting to receive. At the same time, we are going to recognize that provision because more debtors are likely not to pay us. So our receivables, meaning what we expect to receive, is now going to go down more by 1,000 and 2,500, 1 million and 2.5. We are going to reduce what we expect to receive just to be on the safe side. So what do? Let's go to receivables. Receivables is here. Receivables is here. This one here. So we expect to receive 17,600. But as things stand, more of these debtors have been declared. More of this debt has been declared bad. They'll be defaulted. So we are going to reduce what we expect to receive. Remember, receivables is an asset and it is in the current asset. It is always debited. What reduces that account, we have to credit. So we go to the credit adjustment and we post that adjustment. And what adjustment are we posting? 1,000 has been declared to be bad, meaning it will reduce what we expect to receive by 1,000. At the same time, we are going to provide for another risk of default, which is highly likely to happen, of 2,500, provision for bad debts, expected credit loss of 2,500, so that our receivables account is going to go down by this figure. That's why we are crediting on this account is always debited. It has normally has a debit balance. When we credit, we are reducing it further. So we're going to reduce it by a total of what? 3,500. We are going to reduce it by a total of 3,500. That is one entry on the credit side. Then at the same time, we now go and look for the debit entry. We've credited. So what is the corresponding debit entry? So we come to our debit entry and say our expected credit loss. We can call it expected credit loss or increase in provision. We didn't have a balance for that because this is something that has come in as an additional information. So I will call it expected credit loss. Sometimes no one will penalize you if you just call it increase in provision. I think we call it increase in provision. Increase in provision. And now we are going to debit it because it is now an expense of how much? 2,500. Now, I want you to notice here, our account has not balanced. You know why? Here, we have reduced what we expected by 3,500, but when we've come to the expected credit loss, we have captured 2,500. That is the expected credit loss that was given. Now, what other adjustments are we doing with 1,000 to balance this account? And you can see we need to debit it. Where are we debiting the 1,000 to balance that account? I want somebody to tell us. Where are we debiting the 1,000? That should be very obvious now. That should be very obvious now. We need to debit it so that the account balances. Bad debts, thank you. Credit loss, thank you. Thank you. So we also go and adjust credit loss. You see that one has 3 entries. So you see under bad debts, we are going to increase it by 1,000. We increase it by 1,000 like that. And our account will balance at that stage. Note number 5. Note number 5. Note number 5. Salaries and wages excludes an amount of 520,000 due to casual employees hired in June 2023. Salaries and wages. Now, the salaries and wages given here in the trial balance, this one here, excludes 520, which is still part of casual employees payment. So how do we adjust the 520? The account that is being touched on directly is salaries and wages. So salaries and wages has been undercasted by 520. Let me use that reasoning. It has been undercasted by 520. It was to include 520 because 520 is part of salaries and wages, but it was not included. So what do? We go and include it. We increase that expense by 520. So let's go to salaries and wages and recognize the 520 that they left out. Salaries and wages come here, and under adjustments, we recognize 520. And then, after we recognize 520 there under salaries and wages, what other account is affected? Because for every debit, there has to be, for every debit adjustment, we have to do a credit adjustment. I want somebody to tell us which other account is affected. Under salaries and wages. We've already adjusted salaries and wages by recognizing the 520 they left out. Which other account is affected by that transaction? Remember, under adjustments, you must have debit and credit adjustments. We must have both because a transaction has to affect 2 accounts. Has to affect 2 accounts. All right. Somebody saying cash and bank. Accruals, Dorothy. Jaden, cash and bank. Now, members, I want to agree with Mika. I want to agree with Mika and Mawia and Dorothy who have identified something on accruals. You know why? For those members talking about cash and bank, remember, in the statement, they did not tell us it was paid. When you pay is when now money moves out of your bank or on your cash, depending on the term which they use. But because cash and bank are appearing in one line, when you pay, you are paying from this account. But did they tell us that they paid? No, they were not talking about payment, no. They just said it excludes an amount of 520 due. The word is even given there, due to, due. Now, being due means it is accrued. It is an owing. It is due, it is a liability, it is an owing. So this owing here, we've already recognized it because it will fall under expenses of salaries and wages. We've added the 520 under salaries and wages. That's why we've debited. But at the same time, they're telling us it is due, meaning it is accrued. It is an accrual. And we know where we normally post accrual in the balance sheet. It is a liability. So we will come, obviously, we do not expect to have accrual in our trial balance. We didn't have any accruals in our trial balance. That is an adjustment. So we will have to recognize accruals. We'll have to recognize accruals. So I will write there accruals. And even as I write accruals, we can go ahead and specify because accruals is a very wide term. And the first accrual that we brought in is salaries and wages. That is the first accrual. That is the accrual that we brought in, salaries and wages, like that. So this accrual of salaries and wages, we now go and credit. Remember, we debited salaries and wages. Now we are crediting accruals, and you'll realize that our account will now balance. That entry is complete. Our account is balancing. We go to the next element. And in that note 5, we've not exhausted it. They gave us something added there. In addition, the audit fees are estimated at 1.2 million. Somebody tell us, how do we post the audit fee? Remember, this is not an adjustment. Did we have audit fee in our trial balance? I don't remember seeing anything of that. So it is not an adjustment, it's a posting. It is a posting, not an adjustment. How do we post audit fee? Which accounts? Debit, credit, very fast, debit, credit. We want to post it. Audit fee expense, okay. Audit fee debit, and then you credit accrued fee. Okay. Okay. Interesting. Debit audit expense. Okay. Now, I will agree that we are going to recognize that audit fee as an expense. We are going to post it as an expense. And is there any other area that it is going to affect? Any other area that is going to affect the 1200? It is an expense, yes, I agree. It's an expense. But have we been told that it was paid? Thank you, members there. I can see RM, and there was also Steve-O, who have realized that however much Mika is talking about provision. Mika, do we normally provide for audit fee? Do we provide for audit fee? Do we normally provide for audit fee? That is new to me. I'm not very much aware. Do we normally provide for audit fee? I don't think if we would do provision for audit fee, because audit fee will always be a known figure. We only provide for an estimate, something we expect not to materialize. But audit fee, it should always be set by the auditor, so you cannot provide for it. You can only, we only use accrual basis to recognize the expense, but we ask ourselves whether we've paid it or not. So thank you, Mika. I've seen you've corrected it and said it's an accrual. It is accrued. So let's, yes?
Yes, Mwalimu.
Yes, Collins, go ahead.
In a real setup, for example, there's a circle where I'm a treasurer.
Yes.
We normally do the budget in advance so that the members can approve. And in that budget, we have to put on a provision for the audit fee in the budget for the approval by the members during the AGM.
So Collins, I'll ask you a question directly.
Yes.
With your level of understanding at this point, do you feel it is correct to say that audit fee is a provision?
No.
Yes, so that's why we are learning. So, because really, realistically speaking, it is good to say, to know that at some point we're going to pay audit fee. But calling it a provision means you are not sure of the amount. But I know that auditors are always vetted, and it is approved who is to be the auditor. Appointment of an auditor, vacation of office of an auditor. You remember those things that we learned, right? Yes? And
yes.
Even the compensation of an auditor is always set. So whenever you vet an auditor and the auditor accepts, signs that acceptance letter that now we accept to be auditors, because even if you are doing your budgeting, there was an auditor who should have been in the office. That auditor who should be in the office already has a fee that they've been charging. So even if you are doing budgeting for this current year, you will still use, unless you've already vetted and realized that whatever was being charged by that other auditor is likely to change, and you should have a definite figure. You don't call it a provision. Just call it audit fee. Don't add any provision there. Just call audit fee, because you should work with a definite figure. Yeah, so I think that's something that we need to check. I don't feel
it is okay, Mwalimu.
All right, thank you. So I was talking about the audit fee, and we are going to recognize audit fee. It was not in the balances there. So audit fee. And remember, because now I know it is a new posting, but because now it is going to affect accruals, and accruals is already under adjustments, we must make sure we recognize the audit fee. It will be recognized as an expense. I believe we all agree this one will be an expense of 1200. And at the same time, we have to ask ourselves, has it been paid? they've not told us if it's paid. So it will go and land in our balance sheet as a what? As a liability. Did I pick on the accruals? Yes, I did. It is going to land in our balance sheet as a liability or as an accrual. So we are going to add the 1200 there. So we are going to add 1200 there. The first one was 520. I can even type it so that they are all visible what we are adding. 520 plus 1200, that is the total accruals we have now. And at every bit, our account will balance. We know that after recognizing audit fee and debiting it here, we'll automatically debit our profit or loss. So that is the correct treatment of expenses. All right, so I think note 5 we are done. Let's go to note number 6. The loan stock interest paid is for the half year. Now, loan stock interest paid was in the trial balance. Where was it? This one here. And they're telling us it was for the half year. It was for the half year, meaning this is for 6 months. What treatment are we doing with that? What treatment are we doing with that? We were told that 400, it is for half year. It is not for the full year. So what happens? What happens, members? Somebody saying, why not separate the two? HP, I just want to believe that you are talking about my accruals. My accruals. You can separate. You can say audit fee accrued, so that you leave these ones as salaries and wages accrued. But even if you put all of them under accruals, it should still be okay. But I will also agree with you. We can split it. Why not? Why not? So I can say accruals for salaries and wages. Then I can just write another accruals. Then it is audit fee. There is still no problem. There is still no harm at all. I'll agree with you. So even if you lump it up under accruals, the treatment in the balance sheet will still be the same. We will still credit all of them. So long as the balance sheet will balance and our adjustments are balancing, it's still okay. But there is no harm. So if that is the case, then I have to remove my 1200 from here and post it under the accruals of audit fee. And I will just say again, the 1200 like that. Is it on the same line? No, it should not be on the same line. Where is accruals audit fee? Oh, this is audit fee. So this one should be down here. Yeah. So I will agree you can split, or even if you don't split, it will still be the same, but it's okay. That one is well understood. Now, we are talking about this note number, was it note 6? Well, let me go and check again. Note 6. Loan stock interest paid is for half year. What treatment? It is for half year. Credit 200. Win is saying debit interest and credit accruals. Okay. Debit loan stock with 400, accruals with 400. Okay. Okay. Thank you, Steve. This is what I was looking for. Thank you. You know, I was almost asking this. There is a name here which I can't read very correctly. So for the owner of this name, please, you'll forgive me if my pronunciation is not correct. Mnyagano. Hey, why are you stepping on each other here? Okay. So I was looking at this. Why are the charts disappearing for me here? Okay, all right. Okay. So I was looking at, I was almost asking this guy, this person called Mnyagano and the rest, where did you get the 400 and where did you get the 200 for the Messi, Celestine? But now I'm happy that Steve-O has responded there by saying interest expense is 800. Interest paid is 400 and then accrual now becomes 400. That is very good. And someone may be wondering, where did the 800s and the 400s come from? It is very simple. Let's all go to that note. Let's all go to the loan stock interest. Now, in your recognition of the expense to charge and accrual basis, you will compute the finance cost to be paid, right? I believe we all know that. So we will compute loan stock interest. What is the loan stock interest that we will pay? We will pay 10% the coupon rate of 8,000. So we will pay 10%, 10% of 8,000 of course, you'll agree that comes to 800. That is the loan stock interest will come to 800. Then we've been told that the loan stock interest paid is for half year. So if for a full year we need to pay 800, then half year is 400. Then it means there is an accrual of another 400 so that the total interest for the year will be paid at the end of it all. I hope that now someone understands that. I hope someone now understands what we mean by that. Yes, so under accruals, we are having 400 to recognize because we've paid 400. But again, remember, the total charge for the year is 800. So being the total charge for the year, that is the interest expense. That is the interest expense. So we are going to look at the accrued part of it, the accrual part of it. So what two accounts are affected by that entry? What two accounts are affected by that entry? There is the loan stock side. We are going to adjust the loan stock. And again, we are going to adjust our accruals for that loan interest expense, our interest expense. So let's go to the adjustments. Let's go to the adjustments part. In our adjustments part, you'll see there is 10% loan stock, right? You see the 10% loan stock, and then there is loan stock, where was it? There should be loan stock interest paid. Now this one here, loan stock interest paid, loan stock interest paid. Now we've all seen that total interest to be paid was 800. 400 has been paid. Then 400 is due. 400 is due. Now, the entry that we are making here, is to recognize the expense for the year. Now, if the total expense was 800 and 400 has been recognized here as paid, now what that means, there is another 400 that we need to recognize as an expense for the year. Then that very expense for the year of 400, it has not been paid. It has not been paid. So we will go to the accruals. So if we went with the pattern of splitting the accruals, then we will also have to split another accrual and say accruals, and say loan interest, because we decided to split them. We will have to split everything. And we will say now we are adding the accrual of loan interest of 400 here. This 400 we have recognized, it is not paid. The only one that they paid was the first 400. This second 400 is an expense, but again an accrual. Our accounts must always balance at every point in time. The next note, we are just finishing up. And once we finish with the adjustments, everything is just done. Everything will be done. We are in note number 8 now. Note number 8. No, note number 7. We are told general expenses include prepaid amount of 350. Two accounts, the adjustments we are doing. We have been told general expenses include prepaid amount. So general expenses was given. You see this one? It includes an amount that has been prepaid. So how do we adjust this account? How do we adjust general expenses? Let's start from there. Adjustment for general expenses. It is a debit. It's always a debit balance because it's an expense. We credit, thank you. So I want us to start by crediting the general expenses. That is the first adjustment. So we are crediting it. We are crediting it by 350. That is a credit entry. An adjustment must have debit and credit. Which account are we debiting now? Which account are we debiting? Prepayment. All right, thank you. We are debiting, we are debiting prepayment. Yeah, I believe. Thank you, members. So what we are doing, we are now going to recognize that prepayment. So I can just call it general expenses prepaid. Or we can just call it prepayment. I mean, really. Unless there will be more than one prepayment, then we can specify. But for now, it is just a prepayment. And being a prepayment, we credited to reduce general expenses. And now we are recognizing the 350 on its own as a prepayment, 350. And we know where the prepayment goes in the balance sheet. All right, that is note 7. Note 8 is talking about depreciation, which is being charged at these rates. So we know the rules of published accounts. We know that we need to, we normally compute the depreciations. They've given us the formula for computation. So why don't we compute the depreciations here? I just want to do it beside here very fast. Depreciation. Now, depreciation for motor vehicle, motor vehicle, like that. We are told it is on a reducing balance. So I will come here, put an equal sign. Then on reducing balance means if it is 30%, if it is 30% per annum, then it is 30% of the reduced balance. What is the reduced balance? It is cost minus accumulated depreciation. Where is motor vehicle at cost? The cost is 19,700. Then we are reducing that balance by the accumulated depreciation, which is now 6,300. They gave us here. Now, that reduced balance, we are charging 30% of it, and we are getting depreciation charge for the year as 4,020. We do the same for office furniture. For furniture now is on a straight line. Now the straight line is 10%.
Excuse me, Mwalimu.
Yes?
Just put your cursor on 40/20.
I've put it.
It's all right.
Okay. So for furniture is depreciated on a straight line basis, and it is at 10%. So straight line mean 10% of the cost, 10% of the cost. Where is the cost? Let's go and look for the cost of furniture. Furniture is 32,320. So 10% of that, we are getting depreciation charge for the year as 3232. Then for building, we've also been given the method of depreciation. So for building, we are depreciating it at 2%. Also straight line. So that is also very easy. Straight line is on cost, whereas building 45,000 is the cost of that building. So 2% of 45,000 is 900. Now, members, with this one here, let's now post the treatments. Let's now look at how are we adjusting or posting these computations of depreciation. How do we post the depreciations? Let's go to our workings here and see. How do we post the depreciations? We normally know that depreciation is an expense that we charge in the income statement. Is that correct? Yes, it's an expense that we charge to the income statement. I'm just looking for something. Beside being an expense, how do we, because we know for every debit, there has to be a credit entry. Debit depreciation and credit accumulated depreciation, all right? Okay, debit depreciation. So thank you, Grace. The Messi is only giving us one side, which I can start with. So for the one side that we have there, I can start with it, and I can just call this depreciation for the year. And depreciation for the year, now we have the figure. Remember, we have the figure, and I'm putting it under adjustments, and the figure is already there. Did we add the total? No, I've not added. But when I refer to that and I use Alt equals, the figure is 8152. That is the total depreciation. That is the total figure. Now, what other credit posting are we doing? We've done debit. You see our account is not balancing. It has to balance. So I'm looking for members to tell me the credit posting. Credit PPE, all right? Accumulated depreciation or provision for depreciation, okay. Okay, credit asset, credit PPE. Interesting there. Interesting there. There is something I'm looking for, I've not seen. There is something I'm looking for and I've not seen it. I'm seeing members just talking about asset, provision for depreciation, accumulated depreciation. Now, members, we already know how we've computed depreciations, right? We know that we've done depreciation for every element of asset, motor vehicle on its own, furniture on its own, building on its own. Now, in the trial balance that they gave us, you will see that they also gave us accumulated depreciations of this element separate. Motor vehicle has its own accumulated depreciation here. When we come to furniture, it has its own here. Yes? So all of them have their cumulative depreciation separate. Building, where is building? Building also has its own here. So what we are doing, let us add them into the accumulated depreciations of the specific elements or the specific assets. So we will come here and post, for example, let's start with this first one. Where is the first one? Motor vehicle, we add 4020. We adjust the accumulated depreciation by 4020. So for motor vehicle, where is motor vehicle? Its accumulated is here. So to increase accumulated depreciation account, you normally credit by 4020. Then the depreciation for furniture is 3232. So let's come to accumulated depreciation for furniture. Where is furniture? It is here. So we recognize the 3232, which is the depreciation charge for the year under that asset. We do the same for this other asset called building. We also add to the accumulated depreciation of building. It is here. It is how much? I've just forgotten, 900. We add 900 there. So in essence, you see we have credited the total of 8152. We debited it here under depreciation for the year, but now we are crediting the other total, each on the accumulated depreciation side. And we are having the total net effect to be the same. That's why our account also will balance after the adjustment. All right. Is there any other note remaining? There is only one. Note 9, estimated corporation tax rate. This one is not even an adjustment. This one is just a posting. Do we have anything talking about tax? Talking about tax in the trial balance? Let me just check. Was there anything about tax in the trial balance? I can't see anything about tax. No, I can't see any of that. So we recognize the tax charge for the year. Tax charge for the year. So we can call it, let me just call it corporate tax. Corporate tax. We know that it is the corporate tax charge for the year. And we are recognizing it as an expense, and we know that we normally debit it. Now, I want a credit entry for it, a credit entry for it. How much is the tax? We've been told it is 6,500. What is the credit entry for it? Credit entry for tax. I just want somebody who has been keen enough to look at it. Credit entry for tax, I've debited as an expense. It is not statement of financial position. No. Tax payable. Thank you, Mika. It is an accrual. Thank you. Thank you. That's what I was looking out for. Remember, tax charge for the year, you have to pay. You have to pay that tax. So if you are not told whether it was paid, then you need to always know that any expense that is not paid and is supposed to be paid is a liability. So we will talk about also another accruals, but it is on corporate tax. Accruals, but it is on corporate tax, and we know where accruals fall in the balance sheet. So this corporate tax has not been paid. So we are adjusting by crediting the same amount of 6,500 like that. Our account has to balance at every bit. Those are all the adjustments, members, that we are supposed to do. So do you know what is remaining next? Just transferring. Any account with an opening balance, we adjust with what has been adjusted, then we post it where it should go. That is the only remaining thing. That's why I highlighted this area to tell you this is the only important area here. This is where you can go wrong. And if you go wrong here, all these others will be wrong in most cases. So let's now transfer the postings. Now we are not going to check on the question or any of these additional informations. We are done with all of them. We just focus here and do the postings. We are just transferring and posting, transferring and posting. The Messi is saying, I repeat on tax. Now, the Messi, we've been given a figure of tax charge for the year. Tax charge, tax is normally, corporation tax is an expense, right? I hope you know that. Being an expense, we normally debit it in the trial balance, meaning it is in the statement of profit or loss. We normally debit. That's what I've done. The first entry, it is here. Then, you normally know in published accounts or preparation of financial statements, after you recognize your finance cost and corporation tax in the income statement, you normally ask yourself, will they be liabilities to go to the balance sheet or not? Were they paid or not paid? Our tax was not paid. The same way we recognized loan interest, part of it as a liability. We were told part of it was paid, the other part was not paid. The part which is not paid is an accrual. Our tax was not paid in full, meaning the whole amount is also an accrual. That's why we've credited it. And it is going to go to liability section in our balance sheet. That's what we are going to post next. So let's do the postings, members. The first one is ordinary share capital. We added it here. Now, any credit entry with another credit is increasing the account. So these ones here are equity elements. They do not affect profit or loss. So we just simply go and adjust it. So I'm adding ordinary share capital with the amount we adjusted to give the total in our statement of financial position. It is not affecting profit or loss. Preference share capital did not have any change, so we are crediting the same amount. It does not have any change. Yeah. Revaluation reserve was adjusted. There was a revaluation, so we are also adding the adjustment for that. It was credit by credit. That means we are adding that account. Retained earnings did not have an adjustment, meaning it remains the same. It remains the same like that. I hope we are following. Then we come to inventory. Remember, this is an opening inventory. This is an opening inventory. It does not affect our balance sheet. It only affects our statement of profit or loss. Following the computation of cost of sales, we normally just add opening inventory. We start with opening, add purchases, less closing stock, blah, blah, and all that. Receivables does not affect our statement of profit or loss, but it goes to the balance sheet. Now, a debit and a credit means we reduced that account. So we will go to our balance sheet and debit the difference. It was 7,600, but we reduced it by 3,500. That the bad debts that were declared. So our debit balance for the trade receivables now is 14,100. We go to cash and bank. Was there any adjustment for it? No, it remained the same and it is debited in the balance sheet. Trade payables is a liability. Trade payables is a liability, did not have any adjustment. So what we do, we just transfer it there. Loan stock it goes to a long-term liability section. Sales is not an element of balance sheet, but it is an element of the income statement and it is credited. So what do? We credit sales like that. Then credit loss is an expense and it is affecting our statement of profit or loss. So this was a debit balance with a debit balance. Then it means that account went up. So it is debit and debit like that. It went to 27. We do the same for salaries and wages. It also was affected by the same. So that formula, I can just autofill it to add the two, debit and debit. Then these other expenses here did not have adjustment, but loan stock interest paid had an adjustment here. Then directors' emoluments did not have. So all these expenses, I can just autofill this formula here to bring on board all those expenses up to this point. Because for expenses, they're normally debited. Any debit is increasing them. So you can check here. The net effect of loan interest, the total charge for the year in the income statement is 800. I believe we know that. And we do not post expenses in the balance sheet. So that's why all the way from here to here, we've only affected our income statement, not the balance sheet. The balance sheet is not affected by any of this. The balance sheet will only be affected by accruals on the same expenses charged, if not paid. I hope we are moving together. I hope we are moving together. Oh, somebody saying I skipped purchases. Where is purchases? Let me see. Okay, thank you so much. Thank you so much for that. Now, purchases do not affect balance sheet. Yes, purchases will come and affect our computation of cost of sales. So we need to debit. It did not have an adjustment. We need to just recognize the debit there like that. Then we look at these other general expenses. A debit and a credit means it is reducing. So we reduced general expenses by this prepayment that was recognized. This was a prepayment. We recognized it down here. You remember that. Then we look at motor vehicles. This is an asset. This is an asset. So it will go to the asset side and it is debited. And remember, it has accumulated depreciation. Normally in the balance sheet, we prepare we put the assets value at net book value. So we just post the entries the way they should. So accumulated depreciation for motor vehicle, we adjusted it by 40/20, meaning it went up. So on the credit side of the same, we are now adding the two to adjust so that the net effect will be the net book value of what? Of the motor vehicle. Total cost minus total accumulated depreciation will have a net book value. So that is how that account will balance. We do the same for furniture. Cost did not change, so the cost is the same, but accumulated depreciation was affected. So the same way we've done with the other one, we will add the adjustments. Remember, it is credit and credit. That means the account is increasing. We go to land. The cost of land is here. There is 4,000. There is 4,000 on the line of land. So we will increase land by the same 4,000. We will increase land by the same 4,000. I believe that that entry we did correctly. It does not affect income statement. It affects this. So we will recognize land there. Then we come to buildings did not have an adjustment at cost. So we just recognize it there. But accumulated depreciation was adjusted the same way we've done with the other motor vehicle like that. So we add the two to have the total accumulated depreciation. The net effect will be the net book value. Then suspense account. Suspense account. Do we have suspense account in the balance sheet? No, but it is. Do we have it in the income statement? Somebody tell us. Do you think suspense account will affect our income statement? Do you think in the income statement we need to recognize suspense account? Members, do you think suspense account is recorded in the income statement? The answer is no. Thank you. The answer is no. So do not transfer any of this in any of these accounts. There is no suspense account in the income statement or balance sheet. We check on the next one. Closing inventory, we know the adjustments. It has to appear in the balance sheet, which of course we already posted. And then we also credited the income statement. That one we already did, so I don't have to repeat anything there. Credit loss there will have to affect our income statement by the same amount because we know that one is an expense. So it is just 2,500 and it does not go to our balance sheet. So credit loss, we debit 2,500. Accruals now, these accruals do not affect our income statement. They all go to the balance sheet as credits because they are liabilities. So I will refer to the first accrual, which is on salaries and wages. Then I will bring the next accrual, which is audit fee. Okay, it's all right. I will assume I will not add anything. Okay, so we come there and the accrual for audit fee, I've put it there. Now, audit fee itself is an expense, so it goes to the income statement. It does not go to our accrual or the balance sheet. We look at the accruals of interest. This is a liability. We have to recognize it there. We go to prepayment. Prepayment is an asset. I believe you know that very well, members. Depreciation for the year do not go to the balance sheet, but it is an expense in the income statement. We know that corporate tax is an expense in the income statement, but again, the same corporate tax was not paid, meaning it is a liability to be recognized there like that. Very good. Very, very good. Now, up at that point, after you've done all, you've also heard what was happening. It's okay. Wakire. Okay. All right. Now, at this point, in the statement of profit or loss, when you check the credits, that is the sales, you check on this closing inventory. Now we ask ourselves in the income statement, did we make a profit or we make a loss? Now that profit or loss will be the balancing figure, So is the credit side higher than the debit? Then the balancing figure, we call it what? Now look at the profit or loss. The credit side is higher than the debit. What does it mean? Is it a profit or a loss? It is a profit. Thank you. That's your name, Munyagano. It's okay. You translate it in English and it will sound very funny. Okay. Okay. So the balancing figure is profit. I will just call it profit for the year. Profit for the year, like that. So profit for the year is the balancing figure, and I want us to look at the balancing figure is the difference between the two. So that profit for the year will be debited. So it is the balance between 363 to 50. I believe you know why I'm typing. I'm not referring to cells. There will be cross-reference error because it was the same cell also that gave us this total. So if I refer, there will be a cross-reference error, 351, 582. That balancing figure is our profit for the year. Where do we normally take profit for the year? Where do we normally take it, members? How do we normally treat the profit for the year? Preparation of financial statements, published accounts. This is something we've done. Somebody to tell us. Our income statement is done, but our balance sheet is not balancing. Retained earnings, thank you. We normally take it to retained earnings, and retained earnings is usually a credit balance. So, however much there is retained earnings here, but the retained earnings is the opening one. You see, the one that we were given in the trial balance was opening. So, we will credit the statement of financial position with the amount of profit that has been made. We can call it retained earnings. So, I will transfer the same here, and I can see our balance sheet as balanced. So that means all our adjustments were correct. Of course, we know there are always errors of omission, commission, complete reversal, and all that. But we assume that those errors were not, did not happen in this our case. So that is all that the examiner wanted. Now, the reason why examiners love this question, as I finish, is because it is very long. And in most cases, you might not be able to get time to complete it. So